Let's get underway, and I'm going to ask Brett to kick things off. We're going to spend just 5 minutes just looking at the past 12 months. And so, Brett, can you lead us on your thoughts on how we've ended up here in July of 2015?
Sure. Thank you, Jared, and thank you, everyone, for having us here today. I might open sort of describing what an eventful last 12 months has been, because there has been a lot going on underneath the surface. And rather describe what they all mean, potentially then we can go through the panel and talk about some of these topics. I think a lot of the focus over the last 12 months has been, when you look at the US, will the Federal Reserve start to move away from zero rates and start a hiking cycle, and how normal will that be? Meanwhile, I think most other parts of the world are still easing. So we really only have one central bank, being the US, that's contemplating moving away from their easing or being on hold cycle. That sort of divergence manifested itself in significant currency moves over the last 12 months, mainly characterised by significant US dollar strength. We saw big moves in commodity prices. I think they were drifting off for a while, but as we all know here, iron ore, oil, things like that have come a long way. What does that mean about global growth? What does it say about the inflation backdrop? It's probably worth talking about that. Some questions potentially about Chinese growth, and I think things like European QE2 and just how low we saw some of the government bond yields get there this year. I mean, who would have thought a German 10-year bond yield could have got down to, I think it was 0.07%. That's incredible. But I still think the background is very much one where, if net you look around the world, most central banks are still easing. And I use the word still easing because most of them have been easing in one shape or form since 2008, and it's really only the Fed, and most focus being on the Fed, that we're moving away. It was only this week, I think, that Canada went again based on these commodity prices. And we've also had the odd flashpoint, I guess, with Greece and China, the share market over the last few weeks. Probably off the headlines now, but potentially worth a comment as well.
Jeffrey.
Yeah, so against that backdrop, it's been, another year of very strong experience for us investors here in Australia, and it really has rewarded those investors who have coped with some of this uncertainty and in some parts confusion in the markets over the last year to two. Investors now, reflecting on the experience post GFC, have been rewarded with, close to double-digit annualized returns now for about 5 or 6 years. Last year, across most asset classes, investors were rewarded with double-digit, if not exceeding 20% returns in many riskier segments of the market. So it's certainly been a case of investors being almost spoiled with returns amidst an environment where, if you think back a year ago, many people wouldn't have been projecting those sorts of returns for the U.S., certainly property. Even in the fixed interest side of the markets, the returns there continue to be much higher than investors would have expected, had we been discussing this topic at this panel a year ago today. That has very important implications for how we think about positioning portfolios going forward and setting the right kind of expectations, I think, for investors in what will probably be a little bit more of a challenged return environment going forward. I know that'll be something that we talk about later today on this panel.
Stephen, we'll come to the question of what this might mean for super funds a little later on, but just your take on just the past 12 months.
Well, I was saying before, I've been a financial market economist for 29 years, and I never thought I'd have to write so much about Greece. So that's been occupying a lot of time. But the interesting thing about that is, it's really significant for the people of Greece, and clearly because Greece is part of the euro, the rest of the European countries didn't want a euro member defaulting on the rest of Europe. But I've been really kind of struck by how significant investors here in Australia have taken Greece on board. We've had a lot of, if you like, our retail clients are really quite worried about events in Greece. I was surprised how concerned people here in Australia were about what was happening in Europe, and I think that was because people were hit really hard by the GFC, and they were worried. Here we are nearly 7 years on, still worried about international events really impacting our local market. So That's been a really important factor. And I agree with the commentary. I think the Fed will raise rates in September, but it's hard to see any other central bank around the world doing the same anytime soon. In fact, I think you'll get more easing out of Europe, we'll get more easing out of China, probably more easing out of Japan. The Canadians went last week, the Kiwis will go this week, and I think we'll cut rates again as well. So, really divergent world in terms of policy.
It is interesting. I know your reference to Greece, the immediate payment that was going to send Greece into default was calculated recently by a commentator as being half the amount that Australians spend on pet food. So that it's one of those kind of matters where you've got to get a bit of perspective on this, isn't it?
Yeah, I mean, Greece owes a bit over 300 billion euro. I think it's 312 billion euro. They owe the IMF 1.6 a couple of weeks ago. They're still in arrears on that, of course. They owe the ECB 3.5 billion today. These actually are not very large numbers, right? So, but it's the principle of the thing.
Speaking of principles, Nick, come on.
Yeah, look, I think that you touched on one important theme there from the last 12 months, which is that of divergence. So despite Jeff's comments about being quite a flattering environment for returns, when you look at what fundamentals have done underneath the surface, bar the US and maybe the UK, it's been a year where most areas have slowed down even further, and where markets could, rightly be accused of being flattered by central bank policy. So you've had this sort of central bank fire blanket that's been thrown over a lot of markets and subdued any outbreaks of risk aversion. And yet, whilst that's been happening, Australia has slowed down, emerging has really slowed down. So that strong dollar, weak commodity backdrop has been quite a challenge for emerging markets. And you're really asking yourself the question: should we not have done a little better in recovering this far? What are we, 8 years after the financial crisis? If there's been this much thrown at markets, and yet still we're only just starting to see some signs of tentative recovery, that's not very encouraging necessarily for the future, I would say. So we will get to that later on, but I think that's one key theme that's been that's been mentioned so far.
Okay, so we've got the Fed likely to return to lifting rates at some stage, but widespread easing elsewhere. No one talks about inflation anymore, strangely enough, despite all the easing that's going on, or at least few people do. You can correct me here from the panel if you've got different views here. So how are consumers feeling? There was a reference to a surprise at how people were focused on Greece, but in general terms, what does the panel think about general consumer confidence at the moment, which will feed into the question a bit later on about superannuation? Who wants to kick off on that?
Maybe as the economist on the panel, I might do that one. But yeah. So consumers are feeling very unconfident. Mm-hmm. And I think there's a few things going on. One is, well, the headlines. So as we talked about Greece, China slowdowns all over the press. But I think what really is happening underneath is the slowdown in income. So GDP growth is growing at roughly 2.5% in Australia. Income growth is pretty much zero, in fact slightly negative. So terms of trade's falling, commodity prices are falling, and wages growth is very low. In fact, real wages growth close to zero. It's really unusual. So people know they're not getting big increases in income. So they're now having to save less to keep their spending going. So you can see the household savings ratio really beginning to fall. And so when we have a rate cut and we have a budget that's perceived as stimulatory, consumer confidence goes up. And then the next month it goes down even further than it was the month before. So the most recent consumer confidence numbers have all been very soft. And I think it's really about income and just general perceptions about what's happening in the global economy, which, as we've already said, is not that great.
What's the view?
And I'd say one of the things we worry about with consumers, I would agree with many of these same points about how they're feeling a little conflicted about many of the data and the readings that are out there. One of the things we worry about consumers is, against that environment, they're hearing about potentially lower rates here in Australia, probably higher rates, particularly coming out of the U.S. They know what that might mean for bond prices, so that might be influencing how they think about positioning their portfolios there and being wary of bonds. At the same time, you know, many of us are talking about what is likely to be a much lower return environment going forward. You know, in certain pockets, that's leading to investors bidding up prices on certain asset classes to levels that are, you know, in some cases just a little bit frothy. So it's always at these later stages of the cycle where you worry about, you know, that risky behavior begetting volatility down the line from there.
Do you mean in property and investment? Sorry, in infrastructure?
Well, I mean, property would be one example of an asset class where, you know, I think certainly the returns that we've achieved over the last 3 to 5 years would be above those we would expect going forward in certain areas of the equity market, namely the U.S. You know, our forecast would be, you know, a little bit subdued today relative to what investors would have been accustomed to receiving over the last 3 to 5 years, yes.
Brett, your take on the consumer reaction?
Yeah, it's interesting, isn't it? I mean, I think we've got to keep in mind too that it has been a very, very long time since Australia has experienced a recession. There's probably been a couple of moments, 2008 and 2011, where things felt a bit like that, but we didn't actually register it. And so I think in many ways, despite, I guess, a big come off in commodity prices and, you know, growth stimulus, I guess, from China, I mean, things have still been ticking along okay. And I think the natural stabilisers in the Australian economy with a lower Australian dollar, for example, a very strong central bank, and I know it doesn't seem like it, but a relatively strong public sector balance sheet. I mean, generally, we almost have a positive bias in the economy where, you know, 23 years of good times, even though it hasn't always felt like that, does mean that there is a more resilience here, I feel. And I think when we look at investor behaviour, I think part of the hard thing is that we've been through a period where central banks have explicitly talked about wanting asset prices to go up and encouraging that. And we're now at a point where it's hard to see value. And, you know, as we try and transition away from that, what happens to those values? And so I think when you look at the investment universe, it is difficult to see attractive opportunities. And I think you can see some hesitance there. And I think in other places in the world where you don't have interest rates, I mean, most other parts of the world are sitting around zero. Here we've still got 2% as a cash rate, and so things like term deposits are relatively attractive, given that it's hard to see value in some of these ways. So I think some of that behaviour is just a natural reaction to that.
Nick, this to you. That subdued investor confidence that's been referred to, your organisation is obviously an international organisation. Is it pretty widespread? Is that what you'd...
I think widespread is the perception that it's been a very flattering 12+ months, and so
in performance,
in performance terms, and so in terms of working out where to from here, which is what a lot of folks in the room will be most keenly focused on. In looking at that, I think we're seeing a more and more sanguine approach taken. So if you look at our European investor base, you know, a few years ago, the idea of Australian bond yields at 3% would not have been very interesting at all. Now, I wouldn't say it's quite beating down the door, but you know, the idea of Australian bond yields at 3%, AAA sovereign, you know, a currency that's already come off, that is an awful lot more interesting. And so the level of interest that we've seen in relatively safe assets that at least give some yield has really risen. I think that tells you the psyche of some of the investors there, that if they're happy to A, not lose their capital, and B, generate a little bit of income, that is now commensurate with having had, you know, a good experience. So I think that speaks volumes. So the other thing I was going to add for Australia is that despite having had, you know, despite having rates at a historically low level, despite having unemployment which looks quite reasonable, 6%-ish, you know, we still have consumer sentiment that is around recessionary type levels. Both the level and the momentum of consumer sentiment are weak. And so that's unusual to have had such aggressive, relatively speaking, such aggressive easing, and to have an unemployment rate that doesn't seem to have risen much, and still we're down in this sort of doldrums type level. And I think that speaks something to the structural shift in Australia now, having had, you know, multiple commodity sector driven windfalls. I think that structural shift to think, okay, what's Australia's next trick from here? And I think generally that's in the psyche of the populace who realise it's going to be pretty hard yards from this point on without those tailwinds.
If that's, let's translate it back to the world of many people here in the audience, which is the superannuation funds. If you've got these two contrarian positions, one of which is subdued confidence, but on the other hand, I think it was referred to that it's been the 5th year, is it, of close to or double-digit returns. So you've got members of funds who are quite used to getting high returns, and yet out there in the general community, they've got rather subdued confidence. So how does that play out for people in this room who've got responsibility for asset allocation, for making judgments about where they should be parking other people's money? Who wants to take that one on? Brett, you want to kick that one off? That's an easy one for you.
Yeah, it is interesting because I think with the ongoing lower for longer direction, I guess, of bond yields that has been sort of relentless over the last 6 or 7 years, I think most people would have thought 2 or 3 years ago that we should have been lowering our return expectations, and I guess we've been surprised that markets have gone on, I guess, with the central bank support, and those good returns have still kept coming through. But each year as we go along, I think it gets harder and harder to foresee how they could continue. And look, I don't think anyone would outright say that there's not the chance of, another good year in equity markets and things like that. But I think structurally, it is becoming harder and harder. And I think even central banks themselves are quite concerned that to some extent, they do know that they've elevated asset prices. They do know that they're in a corner, and they sort of don't want to stimulate too much more. They do want to stimulate growth, but not so much asset prices. And so how do you bring the growth through at the same time as not influencing asset prices up to more bubble-like levels? Or I shouldn't say bubble-like, should I? But ultimately, that's sort of the dilemma. It's a tight corner. Growth continues to disappoint, yet markets will take all the liquidity. And I think potentially it is what we're really witnessing is the overuse or over-reliance on monetary policy as a primary tool here to try and get growth up. And what's happening is the excesses of it are finding its way into financial markets and not really manifesting itself down into true structural economic growth. And so from that point of view, can it continue? Well, it's a hard one because in my mind, it doesn't look like central banks are really backing away from that. I think the Fed is trying to move away from that. I know that they talk a lot about monetary policy being one tool, not the tool. But even still, I think their delicate path, if they are to move away from zero, is one that will be very slow and glacial. So they don't really want to upset that. And I think markets, being vested interest, do want things to continue, and they will push valuations higher. But I do think in many of the defensive components of portfolios, the ability to produce very good returns is becoming more challenging. And we have to start having conversations around sometimes it's a sensible thing to take a lower return and take a lower risk than ride the roller coaster. And we might be getting closer to that point in the next sort of 12 to 18 months.
But you would have been wrong about that 2 years ago, though, wouldn't you?
I would have been wrong about that 2 years ago.
Jeffrey.
Yeah, just a couple points on this topic. We also don't want investors to become, too negative in this environment either. Yes, we do not see forward-looking returns from here being, the same that we've experienced over the last 2, 3, 4, 5 years. But by the same token, it's not a hopeless environment either. You're looking at forward-looking returns on cash of around 2. Bonds, let's say, our model simulations would project around 3% or so annualized over the next 10 years. On global equities, somewhere in the 6 to 7% range. These are nominal figures. But when you think about the very low inflationary environment that we're in right now, we're also not projecting inflation to be certainly anywhere close to historical levels either. So when you blend all that together the way that many super fund investors do, it gets us, based on our projections, to around a 6% or so nominal return over the next 10 years. You take inflation out of that, you get to CPI plus about 4. And that's after a period of time where investors have become used to CPI plus 7, CPI plus 8. Certainly nobody would expect that over extended periods of time. But if the target is CPI plus 5, now's probably the time to be thinking about how comfortable you are with something that's maybe just slightly below some of those longer-term averages, but certainly not hopeless, and certainly in our view, not warranting taking aggressive actions to reposition the portfolios to necessarily try to make up that difference today.
Well, That'd actually keep our regulator pretty happy, because most of the funds in this room, I imagine, have got in their product disclosure statement something like a CPI plus 4%, maybe 4.5% in some cases. So CPI plus anything higher than that it keeps us within the regulatory position. Stephen, you're the, as you say, the economist in the room. Your thoughts on what super funds should be?
Well, I agree with the commentary in terms of the level of returns we should be expecting. And so I thought, well, I think there's two aspects.
By which you mean 6 in that
Yeah,
order.
so let's say, high single digit or medium single digits. But I think there's 2 key points. One is, well, that then requires an education process to, from people like us to our clients and to the retail mum and dad clients. And so, that's just a responsibility that we have to educate our clients. And secondly, following on the point, is that the low returns come because, well, the rate of economic growth is going to be subdued. So nominal GDP growth around the world is going to be quite low by historical standards. So if you get anywhere near 2% inflation in Europe or Japan, I'd be shocked. Maybe you might get that in the US, and probably about the same here. So inflation is going to be pretty moderate, and nominal GDP growth will also be very moderate. So a return of 6 or 7 on your investments is, actually not too bad in that environment. But we have to educate our clients that, that's what the future looks like.
Nick, Jeffrey was pretty modest. He's a modest kind of equities guy, I know. You're in that same space. If you had to make a call and you're a super fund manager, and the call was Aussie equities versus offshore equities, what would your advice be to, of course you wouldn't be giving advice, naturally.
General advice, yes.
Yeah, general advice, that's right. So what would, because there's a very lively debate going on about the degree to which, the domestic market is being swamped, if you like, by the weight of money, but the risks involved in heading offshore are obvious. So what's your thoughts in that regard?
Yeah, I think those risks are tempered by something we've spoken about before, which is the currency. So one of the appealing things about an international exposure is you'll tend to have a fair slug of the US in an international exposure. Well, the US is doing its damnedest to be the engine for the world at the moment. So there's a lot of expectation on the US's shoulders, but still to date, there's been by far the most progress in terms of, repairing of balance sheet, both sovereign and household, and to an extent corporate sector, although less so over the last couple of years, have been heading in the wrong direction. So you've got the clearest signs there in the US exposure. If there's anywhere where you could think that those kind of dividend streams and earning streams are sustainable, it would probably be the US. And then, of course, if everything goes pear-shaped, you will have that, to an extent, that safety valve of the Australian dollar to cushion you there. So on an unhedged basis for Aussie investors, that's actually a reasonable proposition. The one thing that concerns me, and this is just the fixed income bloke speaking, so it's definitely not an informed view. The thing that concerns me about when you look at Australia, we had about 7% returns from the ASX last year once you factor in dividends, reinvested dividends. That pretty much was reinvested dividends that return was from. The capital growth was virtually zippo. And the problem with that is that it's not necessarily very sustainable. So we know that Australian productivity is pretty weak. We know that hacking into the cost base was a key source of those extracted dividend streams. But we know that a lot of boards will get crucified by shareholders if they dare to cut back on those dividends. So what concerns me is more that you get stuck in this trap where productivity and growth can't really grow because companies are not reinvesting in capacity, and yet at the same time you have a very thirsty investor base, be it super funds, self-managed super, that really need that dividend income stream as the major component of returns. And so you get stuck. How does that company grow if you're pulling out all the excess cash that's created and not reinvesting it in capacity? So, that's something that, particularly for Australia, because the dividend payout ratios are so high and dividend yields so high compared to the rest of the globe, I think that's an interesting dynamic for the medium term.
And just on that, investing domestically versus diversifying internationally point, I'd say one of the things that we worry about at Vanguard is just the degree of concentration in the Australian market. The Australian market is dominated by the top 10, 15 companies in the index. They are coming primarily from two sectors that we've talked a little bit about today, in the banks and the mining companies that certainly are going to be having their fair share of challenges over the coming years, coming off a very low interest rate environment. To the extent that there's any sort of slowdown or correction in the property market. And of course, we know what's happened to the iron ore price and the impact that has on the miners. So, there's a lot of very good reasons for Australians to have such a big home country bias that we've observed across portfolios, and franking benefits is certainly one of them. But at the same time, this is also an environment where we'd be thinking hard just about the risks of being so concentrated domestically and the benefits that might accrue from investing internationally, notwithstanding the risks coming from the U.S., Greece, China, Europe, et cetera.
Okay. But before I throw the questions open to the floor, I just wonder whether each of you would like to comment on the one. You've spoken a bit about Greece and the situation in Europe, and we've spoken a little about the United States and the Fed. If you're a super fund manager or involved in the superannuation industry, what issues should you be taking into account in relation to China over the next 2, 3, 4 years? So, Brett, do you want to start the rundown, the panel?
Yeah.
So how important is China, or the issues in China, and what should people be looking for?
Yeah, I think it's interesting, isn't it? I mean, if we were to sort of go around the world over the last sort of 2 years and look at the different regions and ask ourselves what changed, the US really hasn't changed too much, sort of eking along okay, bubbling along. People are probably surprised the growth isn't higher. But ultimately, it's repairing. It's going along well. Japan was Japan with, QQE or whatever it is. And obviously Europe, I think with the currency move that we saw from Japan, essentially going really deep into QE, essentially with the central bank being the only buyer of the bonds, changed the dynamics in markets. And so you got this US dollar strength. But ultimately, these, whether it be Europe getting involved in QE as well, Japan and the US, I mean, most of the Western countries are sort of ticking along with low growth levels. Are they the driver? Were they the driver of the reduction that we've been seeing in commodity prices, or was it somewhere else? And I think the big difference really is that Chinese growth seems to have come off and come off and come off, and still looks like it's coming off. I know they publish reports that say 7%, and I'm not going to argue with that. But if you look at the underlying indicators, they suggest it could be lower than 4%. So we've seen that impact. We've seen that impact with so many central banks this year. It's surprising by continuing to ease, and that impact happening here in Australia. And so I think the question for us is this being managed, and the slowdown is more about a structural, very good path for the Chinese economy. So it's a soft landing. It's not going to be, it'll find a bottom here and things will improve, or is it something more than that? Because obviously that has big impacts here on Australia. So far, I think markets are happy to sort of look through it, as they're happy to look through most things. I mean, forget about what happened with Greece, forget about the China share market. The details aren't important. Markets are very keen to get back to where they were. But I think it's a thing that we need to be focused on. We're looking for signs for it to bottom out and gives it a little bit more confidence, but potentially that huge influence that's been there over the last sort of 10 or 15 years has come off quite a lot, and we might find that global growth levels continue to disappoint, inflation continues to be more disinflationary, even deflationary, and that continues to impact the way central banks approach this. Now, does that mean asset prices go up? It could well, because, I mean, obviously to this point, central bank easing has been very helpful. And the direction, I guess, of China continues to sort of mean that the global economy needs a bit more help, and that's what we're seeing at the moment.
Jeffrey, you got a view on China?
Right. So, I mean, nobody ever said that liberalization of its capital markets was going to be easy or without any sort of volatility or disruptions to global capital markets. And clearly, right now, the Chinese are trying to balance that liberalization that they feel needs to happen with restoring confidence locally in what looked to us like a pretty classic leverage-driven, largely retail investor-driven bubble that's certainly begun to correct. At the same time, it's a market that's impossible for investors to ignore. It's the second largest by GDP in the world. It contributes a disproportionate amount of global GDP growth, although it certainly is going to continue to slow. In our view, it represents a meaningful part in growing of many of the benchmarks against which we invest or measure our performance, and in our view would not be to take a step aside. I mean, I think very clearly it's appropriate to have checked expectations in terms of what that market might deliver going forward. And certainly a slowdown is in the order. But these are some of the natural corrections and some of the natural steps that an economy of that size is going to have to go through as they continue on this journey.
Stephen, are there economic indicators that we should be keeping an eye out for from China?
Well, yes. I mean, as we just heard, the official figure is 7% growth, but it kind of feels like it's a lot weaker than that. We've quite often find ourselves on the optimistic side of views on China, and I think that's the right place to be. I think, there's lots of things to worry about in China, but there's lots of things to worry about in every other country in the world. And, I actually think the Chinese authorities have shown a pretty good handle on, running that economy. The opening up of the capital markets, as you say, has been, well, they opened them up and then they got a gigantic rise in the equity market, and now it's correcting, and so they've decided to close that a little bit. But I think the big issue for China opening up the capital markets, you often hear about Western people saying that we want China to open their capital markets, and what they really mean is we want to invest in China and get some good return on our money. But I think the really most important thing for the global capital markets is going to be Chinese capital flowing out towards countries like us. And it could be huge. It's already started to be huge. We're seeing it in the Sydney property market. Mm-hmm. As far as that's concerned, we're at the very start of that process, nowhere near the end. So if you think we've seen a lot of Chinese capital in Australia in the last couple of years, you haven't seen anything yet. I would have thought as the Chinese capital system really opens up.
Nick, what's your thoughts on?
Yeah, I really agree with Stephen's last point there, actually. I think there's some very prescient articles written about 5 or 6 years ago when China released its prior 5-year plan, prior to the current one, which talked about, this goal of internationalisation of the renminbi, liberalising the capital accounts and so on. And I agree that that was seen as a bit of a one-way street, which is, all right, okay, this is a chance now for, investment banks, which deployed, a fair amount of personnel to go and try and get a piece of the pie there. But the real impact will be, this is a nation with a huge amount of savings, a massive amount of savings, because there's been no social security safety net. So whether that is savings in physical property, in businesses, in treasuries, that could have a colossal effect on real assets globally. So I think you've got to treat China with a glass half full, glass half empty mentality. Don't discount the ability of Chinese capital flows to boost real assets around the globe, even if its economy itself is slowing and slowing further, which means weakening demand for the types of stuff that Australia digs out of the ground. Now, that's still strong demand, because, the Chinese economy today is an awful lot bigger than it was 5 or 6 years ago. So, 5% on an economy the size today is worth probably 7–10% of what the economy was, 5 or 6 years ago. So don't discount that. But I think being aware of that two-way street nature to China's influence on the globe from a demand perspective, but also from an investment perspective, is going to be fairly important, I think.
So from the last two speakers, what would be a sign that might change your house view on the as in Colonial or Aberdeen's view on the situation in China? What would be something that would surprise you on the downside?
On the downside, okay. Well, I think there what you'd need to be looking at is a change in the reaction function from policymakers. Right. So I think our view has been consistent from the analysts in the region that we have up there, has been consistent for some time, which is growth will continue to slow. It's inevitable. Demographics are not friendly at all for China. Along with Korea, they've probably, and obviously Japan, which is further ahead, but along with Korea, China has the worst demographics in the region from a forward-looking perspective for growth. So expect growth to continue to slow, but also expect authorities to continue to react. And so for me, you'd have to be surprised by some level of inactivity from authority makers, or for some harder push towards reform in the face of demonstrably weaker growth, we'd really need to see that to be surprised to the downside. So, a lack of RRR cuts, a lack of, PBOC intervention, those sorts of things we'd need to see to get really concerned. But, slowing is absolutely locked in. Demographics alone tell you that's happening, as well as the process of reform in terms of moving away from an asset-intensive growth model.
Stephen, is that yours as well?
Yeah, I was going to say, the biggest thing that would surprise me is if suddenly the Chinese authorities were willing to accept GDP numbers being published that were about, let's say, 5%. So at the moment, it's 6.5 to 7, give or take. If all of a sudden, the official statistics are telling you 5, then I think that'll be a problem. But it's hard to see that happening.
I'm going to throw it open to the floor. There's some roving microphones, and I'm sure there are some questions for this audience.
Hi there, it's David Rowley, editor of Investment Magazine. Just when everyone was saying about the high returns that we've had today and how they are likely to fall, I just sort of cast my mind back to 2008, 2009, when I was a journalist just after GFC. And what I was told then was that we could expect a good few years of low returns. And in fact, the opposite has happened. And now we're being told again that we should expect a few years of low returns. And what you were saying in the end there about the Chinese savings possibly buying assets and turning things around. So I don't want to be overly cynical, but that thought is popping in my head.
Who'd like to take on a cynical journalist?
I'll do that. No. Look, I think growth, you're right with asset prices, but growth is really underwhelmed. And so there is a disconnect between asset prices and growth. But having said that, central banks have almost explicitly talked about how their zero rates, their almost $11 trillion worth of QE, is designed to push people out of the risk spectrum. And that has definitely taken place. And who would have thought 7 or 8 years ago that was a policy approach that central banks would have undertaken? We're at the sort of tail end of that, or maybe we're not, because Japan and Europe are still doing QE. And I think what you're probably hearing from the panel is that, we continue to use monetary policy growth. It probably isn't coming through anywhere near as strong as anyone would have thought with that amount of stimulus. And it is supporting asset prices. And unless we see central banks move materially away from that, then the chance that asset prices can keep going is definitely there. But the valuation side of things is probably less attractive. On the defensive side, though, it's very, very hard to argue with lower cash rates and lower bond yields equaling lower returns. So I think net what we're trying to say is that think about where valuations are and just maybe ask yourself whether we're towards the end of the cycle and maybe a lower risk profile is more prudent.
There's a strong relationship historically between where interest rates stand at any given point in time and the subsequent 10-year return on bonds, for example. So at these very, very low interest rate levels, it's hard to imagine an environment going forward where bonds would return, much more than 3 to 4%. In riskier segments of the bond market, credit spreads are at extremely low levels, notwithstanding a little bit of volatility that we've seen in recent quarters, given some of the moves in commodity markets and riskier parts of the markets. On the equity side, there aren't a lot of great predictors of long-term equity market returns, but longer-term cyclically adjusted PE ratios have shown to be a pretty good indicator, and at these valuation levels, PEs are on the high side, and would historically be associated with somewhat subdued forward-looking returns on equities. As I said earlier, not tragic returns on equities, but certainly something closer to the 6 or 7% than the 10, 12, or even exceeding 20% returns that we've experienced at times here recently.
I have a question down the front here.
Yeah, hi, Colin Tate from Connexus Financial. Brett, a follow-up question from your comments earlier, where the stimulus is not really helping the real economy. With the exception of the United States, unemployment is rising around the world. The US is the only economy in the last 7 years that is seeing any seemingly, and there's questions about the data, but any drop in unemployment. Australia is now at 6.3, 6.5-ish, the highest in 20 plus years, and rising under what looks like an increasingly incompetent federal government and incompetent opposition. So my question is, where are the jobs coming from in the medium term in Australia and globally?
Great question.
That's an easy one.
Very easy one, isn't it? Oh, maybe healthcare, ageing demographics. It's a good question. I think what you're touching on there in many ways, I guess, is the concepts, I guess, of demographics and digitalisation. I mean, when I started in this industry sort of 25 years ago, I think you either went into finance or you went into IT. And if you went into IT in those first few years, it looked like the smartest move there was. You had the dot-bomb boom. And, you know, it was great. I mean, these days, though, a lot of those jobs have been moved. And who would have thought that the better one was going into finance? It's a good question. Look, I mean, a lot of the things that Australia has had going for it, particularly from the mining side of things, it seems to have come off, somewhat offset by continued housing exuberance, for want of a better word. It is a good question. I might throw to Steve, actually. I think this is one for him.
Yeah. Believe it or not, I actually have an answer for this question. Well, I mean, the first thing to say is the unemployment rate around the world is not rising, it's falling. The European unemployment rate's now 1% lower than it was at its peak, so it's gone from about 12 to 11. It's still, you know, obviously way too high, but it's falling. And same in Japan, the unemployment rate's low threes. And that's partly because they're running out of people to work, population-wise. But so there has been some progress. But I think the issue here is the world is changing, and it's changing in a dramatic way. And it's changing from a world dominated by industrial sector and the use of capital to one dominated by services and information. So the answer to the question is the jobs will come, but they'll come from areas people just don't expect. You know, the Facebooks, the Apples, the Amazons, a few years ago, who would have thought the jobs that that type of industry would create? So services are really going to be a key driver. Health is very much on the agenda because, you know, we're all getting a lot older. But services will be the #1 employer in this country by a long, long way. You know, not mining, not you know, building stuff and making things and selling them, but services. And you know, I think it's important that we all get on board on that and not try and resist the change. And it's really incumbent upon governments to help that transition, not to resist it. And as far as I can tell, there's only one government in Australia that's doing that, and that's the government here in New South Wales with the infrastructure plans. I mean, that is exactly what every government in the country should be doing, is announcing and building massive infrastructure projects. And if you have to use a little bit of debt to do it, then, you know, so be it. So the jobs are coming. I'm actually quite optimistic on a 5 to 10 year view. And this country is an extremely attractive place to invest, and I think the world will continue to send us its capital.
There's a lot of patient capital in the superannuation funds that could be harnessed to that task.
Exactly.
Other questions from the audience? We've got a question at the back there.
Thanks. Hi, Sean Scallon from Connexus Financial. It's a trifecta.
Oh, okay.
My question's about India. We haven't really elaborated too much on India, and I see more and more reports around the shift away from China for many of the reasons you've spoken about towards India and modenomics, if you will. So would you guys elaborate on that, please? Probably start with you, Stephen.
So when Modi was elected, you know, there was this big wave of enthusiasm, and, you know, he has a level of control on power of India that we haven't seen for a long, long time in terms of his majority in government. And, you know, so the equity market, you know, head off. And the new governor of the Reserve Bank of India was, you know, very highly credentialed and done a great job. And then kind of things have faded because the world hasn't changed overnight. India is quite a closed economy, so they really need to open that up, you know, bring in global competition. Very hard to do. You know, if you think federal-state relations are tough in Australia, you should try India. I think there's 26 states, right? So they've all got their own agendas. But, you know, with a huge population and really starting from a pretty low base, to be frank, there is a lot of upside in India, but I think we're going to have to be pretty patient. You know, they have this thing called democracy, which kind of makes it a little bit more difficult than China to just, go in and get things done. So I think we're going to have to be a bit more patient. But there's definitely expectations that next year or the year after, the Indian economy will be growing faster than China. Probably in the 6s or plus. So I think there's great potential there, but it's not going to happen quickly.
Yeah. Question over here.
Sorry, I was just going to add to that. I think on a 20-year story, demographics are very much in favour in India compared to China. And you're starting from that much lower base. Just to give you some colour there, we've got a very big Asian business, and we've been launching Indian equity and Indian bond funds, and the interest has been phenomenal, and that's in local currency. So you've had, Rajan and Modi have combined to be positive for equities and positive for bonds. Inflation's come down; it's now around 5%. Bond yields are about 9%, so you're getting 4% real. In the context of what we were talking about before, for super funds going forward, 4% real, not to be sniffed at. And it's a market that will only expand in terms of accessibility through licenses and the investability through capital market maturation. So, interesting one to watch for several decades.
And people can get your business card later, is that right, Nick?
You may have sensed a plug in there. I don't know where that's coming from.
A question over here. Hello, Peter.
Peter Lambert from Local Government Super. In 2006-07, real interest rates were down to very low levels as well. And that saw the birth of a lot of structured products, as investors weren't happy with 3% and 4% returns. What's happening with fixed interest now? Are investors happy with low returns, or are they now starting to look for quasi-type products to give them a higher return?
We probably should start at Nick.
Yeah, I can kick off, certainly. So I think if you, on a backward-looking basis, because yields have come down, actually returns have been pretty good from vanilla fixed income. Aussie bonds gave you a little over 6% last year. If you look at European bonds, okay, they got down to exceptionally low yield levels, but the returns were actually really pretty good as yields fell. So we've also got a materially different investment banking business model now than we did in 06-07. So the ability of banks to create and warehouse risk through structured product is materially different to how it was in 06 and 07. If you look at the recovery or lack thereof of the CDO and the structured credit market, really hasn't recovered in any meaningful sense at all since 06-07. The CLO market, yes, definitely that's recovered. And the loans market has recovered, but in far, far simpler products than you saw, in the 06-07 days. So I think system-wide leverage is lower, which means that the ability to generate some of those eye-watering returns that you saw before is really constrained. And I think, genuinely, large swathes of the investment community have said now, look, I won't buy what I don't understand this time round, and I'm happy if the return is lower if I've got more capital certainty. So I think things are genuinely different to how they were in 06-07, but that's not to say at the margin, maybe with some more aggressive insurance companies and so on, who've begun to look again at structured product light, if you like. That's started to reappear, yeah.
I'd sort of say that the big trend that we're probably seeing is that with bond yields getting lower and lower, I guess the real question is how do you approach the fixed income space? So you're definitely seeing people question whether a traditional bond fund's the way to go, and I think there's been an explosion of unconstrained type portfolios. And I think it makes a lot of sense to a point, but to your point, Peter, too, I think it makes a lot of sense if you're looking to protect capital, stay liquid and stay genuinely fixed income-like, but there probably is an element of that where people are abandoning, say, traditional fixed income for unconstrained, seeking that higher return, and that higher return may or may not arrive. So I think that's a big trend, but I think you touch on a very interesting point, and from my point of view, I think talking about returns and return expectations, I think we're at the point in the cycle where complacency sets in. This is the point where people start to say, I'm not happy with my returns anymore, I need more, I want to creep out the risk spectrum, but now's the time that you don't do that. And I think if I had one message for today, that would be where I'm going with it being fixed income or other things, is that if certain asset classes are very low yielding or low returning, it's probably for a reason, and the answer to it is not abandon it and take more risk.
Yeah, and just on On the bond market, I couldn't agree with some of those points more. I mean, we haven't had a significant amount of volatility coming from riskier parts of the market, really reminding us of the downsides that are, you know, sometimes all too common coming from equities and other risky parts of the market. Bonds play a great role in the portfolio as a diversifier. They play a great role in a portfolio, providing some downside protection in a sell-off. We think some of the concerns about a bond market bubble are a little bit overblown. Yes, you know, the risk premiums are pretty compressed in that market today, but the headlines that would have some investors fleeing the asset class because of presumed spikes in interest rates, we just don't see them coming. There is going to be upward movement coming from the Fed primarily, but at the intermediate to long-term end of the curve, we just don't see the inflationary pressures that you would really need to see, you know, a big move up in longer-term bond yields. So, you know, we think that there's a real cost of, you know, neglecting the asset class or potentially going too short with from a duration standpoint.
A final question from over the side.
Thanks, Jared. Kerry Pratt from Franklin Templeton. I just wanted to test the panel's view on Europe in the shorter to medium term. Given the fall in oil prices and ECB's continuing support of a low and competitive currency, could there be a surprise on the upside for growth from Europe in the next year or two?
Stephen.
One of the interesting issues is towards the end of last year and early this year, the economic data out of Greece actually was beginning to improve quite nicely before, you know, we've had all this carry on with Greece. So things were improving, and when you look at it, as you said, you know, it's not surprising because the euro weakened dramatically. And the ECB was, you know, or Draghi, true to his word, whatever it takes. You know, he's just been cut interest rates to zero, then pump 60 billion euro in every month and keep it going until, you know, you get a result. And less fiscal austerity in some of the other countries. So, you know, things were improving. The unemployment rate, as I said, was beginning to fall, and then Greece came along, and that's, you know, kind of blown confidence. So if Greece can be contained, I think we will see some improvement. I mean, I'm not talking GDP of, you know, 3% plus, but, you know, into the twos possibly. Like Spain grew by 2.7% year to the first quarter. If you're a European country or company and you are internationally exposed, so let's say Germany, for example, you know, you export a lot of stuff around the world, I think you're going to do particularly well because the euro will keep weakening, probably parity against the dollar, maybe lower. And you're going to have very low interest rates for a long time. If you're trying to generate your growth domestically within Europe, probably a lot more challenging. So I think the, you know, the outward focusing parts of Europe will do better, and maybe they surprise to the upside.
Anyone else want to buy into Europe?
I think you have to be conscious of how low the hurdle was as well in the first place. You know, when you've got a colossal economy like that that's sort of limping along in a real sense at around about zero, then an upside surprise is a little easier to achieve. But, you know, one of the reasons for the very sharp sell-off in bonds in April, which really affected global fixed income markets, was some tentative signs of forward-looking inflation rising in terms of forward-looking break-evens. So maybe some parts of the market were buying into the idea that the Draghi effect would be a bit more palpable. But I think probably more at work there was this generalised rise in term premia around the globe, which we've seen, and Europe was certainly a part of that. So I think further repair, further improvement will be welcome from Europe and entirely plausible, but I think you still have to bear in mind that that's off an exceptionally low base, and how much that helps the rest of the globe, how much it helps somewhere like Australia, I don't think I'd overstate that.
Well, we've reached the end of our allotted time. Brett and Jeffrey and Stephen and Nick, so thank you all for your thoughts and your candour today. We got to Greece, we got to China, we got to the United States, we got to Australian super funds, and we finally got to India at the end of it all. So we've been very much... my last question would be just to quickly run down the table. So the Australian dollar versus the US dollar on December the 31st of 2015. Just a figure, please, each of you.
Well, safe in the knowledge that no one will check, maybe apart from you, Jared. I'd go along with our house view, which is 72.
Stephen?
The best forecast is always spot, so 73.5.
72, 73.5. Jeffrey, come on.
Yeah, we're tilted to the downside. I'd say pushing 70.
Ooh.
I'll go the other way. US struggles to get away from 0, 77.
Ooh. Okay, so hopefully someone wrote all those down. Thanks very much to the entire panel. Okay.